Hey everyone, this is Kirk here again at OptionAlpha.com, and this is the Trading Alert Recap video here for just our members. Today we only had one opening trade. We had a lot of working trades. So again, like we kind of had between Monday and Tuesday, where Monday we didn't have a lot, and then Tuesday a lot of orders got executed. I'm hoping that a lot of these trades get executed and we get some fills here tomorrow for some of the opening trades that we have on and that have been working for the past couple of days. Got about 7 different orders that we have working, so hopefully we should get those filled tomorrow, barring any crazy movement in the market here. But the one order I do want to go over tonight, it's actually a fairly big size trade. For most people, it's going to be a big size trade. And we sold a vertical put spread in Google. Now, we actually haven't traded Google for a little bit. And so, and that's only because implied volatility has been so low. But recently, implied volatility has kind of jumped in Google. So that creates a lot of opportunity to trade Google on the credit spread side. And that's exactly what we did. So in this case, and I'm going to go over in detail this trade since it won't be that long here tonight for the video, but the vertical spread that we sold in Google was the 10,085 put that we sold, and then we went back in and bought the 1,080 put or the 1080 put to help finance the sale of the 1085. So again, short the 1085s, long the 1080s, and the difference between those was $135 in credit per spread. So again, we sold 2 spreads here, so we took in a little over $270 in credit is what we took in on the trade. Now, why do we pick those strikes, right? Everyone wants to know that. Why those strikes versus some other strikes? And I know a lot of you have asked that kind of question when we actually go over a lot of these charts. And so let's first go over where Google is trading right now. And so again, implied volatility on Google, even though it might be a little bit hard to see, you might have to maximize your video here. All these videos are done in HD so you can see it, but it's 57 is the implied volatility percentile. So it's starting to get up towards that 60th percentile, which is really good. That's kind of our sweet spot for trading vertical credit spreads. It's anywhere between 50 and 75 in the percentile. Anything above that obviously is great, but that's when we want to start talking about iron condors, start talking about things like strangles and straddles, etc., when really high implied volatility. So Google has high implied volatility, but it's not astronomically high. It could be higher. So why did we decide to go on the put side? Well, just the trend that Google's been in. Again, this is just our underlying assumption. You can go on any side of the market here and trade Google, but our underlying assumption is that as we come up closer to earnings, we think Google will just continue to move higher and higher. Again, you got to keep in mind we're trading the February contracts, and we do have earnings that are coming out here at the middle part of February. So we want to keep cognizant of that happening, and we want to understand that it could move the stock. And look what happened to Google the last time it had earnings, had a huge pop-up. So that's the only reason we chose the put side of the trade versus the call side. Again, it doesn't matter which side you trade. Statistically, you should be trading the same probabilities. All right, but why the strikes that we chose? So our strikes were down here at 1085 and 1080, which is a good distance away, but definitely not a huge distance. And I'll go to the actual trade tab of Google, and you can see exactly why we chose those strikes. So again, the bottom left-hand corner always has our positions on. You can see this is a live trade that we made here today. And unfortunately, we're down just about 10 bucks on the day. No big deal. So here's our position indicated by these little tags that have position. And our strikes are at 1085 and 1080. The reason that we chose this is because, again, like we do with all of our credit spreads that we're trading, we like to target about the 30th percentile in probability of being out of the money. So what does this mean? This probability of probability of being in the money, this 30th percentile that our Thinkorswim platform gives us. Well, this actually gives you the statistical likelihood that Google trades and closes below 1085 by February expiration. So we know right away that if there's a 30% chance that Google trades and closes below 1085, that means there's a 70% chance that it trades above or closes anywhere above 1085 at expiration. Now again, it doesn't tell us where Google will close at expiration. It just tells us there's a 70% chance it's here or there and above, and again 30% chance it's here and below. So that being said, then we made our trade based on this percentage and this probability level. That's how we chose what strikes to go after. I know a lot of people that I've coached out there are a little bit more conservative and like to go down to the 20th percentile. So they'll go down to the 20th percentile, which is right down here. This is the 1060s. And so if you're a little bit more conservative, again, it depends on how conservative or aggressive you are. You can go down to the 1060 level, sell the 1060, 1055 put spread, and now you have an 80% chance of success. Okay, so you don't want to go too low, because then you don't take in enough credit to be able to take the trade off later on. Your law of diminishing intent, you just go so low that there's just nothing available there. But you do want to kind of play around between this 20 and 30 range. I wouldn't go anywhere near 40. You want to kind of give yourself some room, but that's ideally where we choose our strikes on these vertical spreads, is looking at that probability of Google being in the money at our strike price and picking a strike that matches our risk profile for the trade. So hopefully this video has been really helpful, at least for picking strikes and where to choose strikes on vertical credit spreads. As always, please add your comments to the video section here below. Get to everyone's comments here tonight, and happy trading.